Hey, everybody, Dave Bartosiak here at the Zacks Research Desk. I'm with Zacks.com. I run our surprise trader service as well as blockchain innovators. But I was always a math econ guy in college. And before that, before running those two services, I ran our momentum trader, which obviously had a little bit of technical analysis to it. So, as part of that, I developed this system of trend, trace, and trigger, which is a KISS method. That's keep it simple, stupid, for applying technical analysis. So, really, what I'm trying to do is reach into this nebulous world of technical analysis with all of its lines on charts and just break it down into a couple of simple steps that everyone can apply, and I feel like can add a little bit of an edge, a little bit of alpha to most investors. So everything you need is already in the chart. So a true technician believes that all of the information that's out there available on a particular stock or on a particular market has already been digested by the market participants, and it's reflecting those expectations that the market has in an efficient manner. So that so whole efficient market thesis, right? So the chart tells you what has already been processed, and and what the market feels about it. So smart money has already shown its hand in that price action. The stocks have already made their move based on these investments coming in, and it's all in that chart somewhere. Essentially, the market has already cast its vote, so you can see based on where the price is and the direction of said price what overall the market kind of feels about that particular instrument. And here's a big one: is that the trend is your friend until it ends. So this isn't one of those processes where you're trying to pick the exact bottom. This is much less about forecasting where something might go and much more about determining right now which direction it's heading. So I always draw the parallel to a car. I'm not here looking at the map, determining where this car is going to go. What technical analysis does for me is it helps me determine what direction the car is facing right now, what the speedometer is reading, and how far that pedal has gone to the metal. So it's not about predicting the future, it's about correctly assessing what's happening right now. So I broke that down into these three simple steps of trend, trace, and trigger. It is a simple framework for smarter trading decisions. Step one, as the name implies, is to identify the trend. Step two is to trace areas of potential support and resistance. And step three is to use a trigger for entry. So, step one, identifying that trend. So, we're going to identify the primary direction. And you can make this as simple as possible or as complex as you want. But overall, you got that eyeball test, which I'm sure all of us can just take a look at a chart and say, hey, it looks like it's an uptrend, looks like it's in a downtrend. But I want to take a little bit of that sort of art out of the equation. You look and you see higher highs, you see higher lows, you see the stock going from the bottom left of a chart to the top right of a chart. It's in an uptrend. If you see the opposite, lower highs, lower lows, that market can be said to be in a downtrend. If the market's moving sideways, we call that range bound. And that's where you can, buy the bottom of the range, sell the top of the range, and you're just kind of knocking it back and forth. To me, trend lines are arbitrary and moving averages are complete. So, just like that same eyeball test, maybe I look at and I can see, oh, there's a top here, a top here, a top here, and I connect the dots. Somebody else can look at that same chart and say, well, there's a bottom here, a bottom here, and bottom here. Connect those dots. So trend lines to me aren't as great to determining where things are going. I don't really like trend channels that much in just straight lines, things like that. I just don't subscribe to that. That's fine if you do. I'm not here to judge. Just telling you what I do. So moving averages give a host of information about trends in a quick glance. There's a lot of information that's packed into a moving average. You can see not only where the stock price is in relation to that moving average, you can see the slope of that moving average. You can see how far that moving average is away from a longer term or shorter term moving average. So you can get a lot. And we're going to kind of cover that here. So what is a moving average? Well, a moving average is the average of a stock or an index closing price over the last X amount of periods. And I say that explicitly because people will apply a moving average to their intraday charts. Let's say it's a 5-minute chart. And then if you put a 50, quote unquote, a 50-day SMA over a 5-minute chart, you're not looking back 50 days. You're looking back the 50 periods. So that's 50 5-minute periods. You're looking 250 minutes, right? But when we're talking here and we're looking at charting over the long term, I'm talking about days. We look at our daily charts, and these are all moving averages applying to those days. So the most commonly used are the 50-day and the 200-day simple moving average. So simple moving averages are calculated using end-of-day prices and represent the average of all these end-of-day prices over the period. For example, a 50-day SMA is the average closing price over the last 50 trading days. Now, there are several ways to calculate moving averages, including exponential moving averages and weighted moving averages, which use recent values as more substantial in the calculation than past values. So it'll say, it'll put more weight on the last 5 trading days, for example, versus the 15 that came before. Okay. There's all types of tricky ways to do it. You can also displace moving averages. You can have a 25-day moving average and scoot it over by 3 days. There's all types of little hints and tips and tricks that you can do. Again, we're keeping it simple here. So I'm just going to look at simple moving averages here. So anytime I say moving average in this, I'm referring to a simple moving average, and it's going to be on daily closing prices. So why use the 50-day and the 200-day? So different moving averages give different trends. The higher the number, the longer back in time that moving average goes. So a 200-day moving average would be a long-term moving average, while a 50-day is more of an intermediate or a short-term average, right? I keeping it simple. So when I have 2 moving averages here, I'm just going to call it long-term, short-term. Okay. There's people who will incorporate a 20-day on top of this 50 and a 200. Now you got short-term, intermediate term, long-term. So again, for the sake of this, we're going short-term, long-term. I use blue for the 50-day moving average on all these charts, and I use red for the 200-day on all these charts. So I want you to go back, way back to your algebra classes back in the day and general form, which is y equals mx plus b. This is the slope of a line, plus that shift on the y-axis gives you where that price is, right? So for moving averages, just as important as where that moving average is right now is the slope of this equation, which is the m. So when the slope is positive, the trend is turning positive. Slope is negative, trend is turning negative. And when the slope is 0, the trend is range bound. Then where is the price in relation to the moving average? So if the current price is above that said moving average, then we are in an uptrend. If the current price is below, the stock is in a downtrend. And where are these moving averages in relation to each other? If the short term is above the long term average, then now the trend is turning positive. If the short term is below the long term, then the trend is negative. So here I wanted to point out something that's been in the news a lot is gold. So here's a spot market on gold after its big spike. into last week. I'm here in the beginning of February, and you see the rollover, pretty nasty. So there's still a strong uptrend in gold that it's above the 50 and 200-day moving average. The 50-day moving average is positively sloped and it's beneath the price. The 200-day is also positively sloped and beneath the price. And the short term is above that long-term average. So this is about as strong of a trend as you can get. Now we're going to do something that's a little bit more of a downtrend. So if you take a look at Microsoft, the 50-day is above the price and negatively sloped. But I threw a wrinkle in this with the 200-day being positively sloped above the price. The short-term average is below the long-term average. So you are in a downtrend, but it could get worse because if that 200-day continues to roll over, then that's when you get into these really strong downtrends. Kind of like Ferrari here. You have a 50-day that's negatively sloped that's above the price, a 200-day that's negatively sloped that's above the price, and a short-term average that's well below that long-term average. So this is a very strong downtrend that you're seeing on this particular stock. So the next step is to trace areas of potential support and resistance. So you could use several things: previous 52-week highs and lows, the swing highs and lows. So these are basically just recent highs and lows, okay, that you see on a chart. Then the one that all the mathematicians love and the technical analysis guys love to brag about is showing off their Fibonacci retracements off of large moves, which we'll show. Then you have gaps. So these are gap ups or gap downs. They typically happen after major news events where the stock really moves a lot in the pre-market and then has to try to catch up with everything later on. And then you have moving averages. So these are the 50-day, the 200-day, things like that. Those are the moving averages that could also be areas of potential support and resistance. So here we drew up some Fibonacci retracements. So this is the gold miners index bull 2 times shares. I only use this just so the move would be a little bit more pronounced so we could see it. This is NUGT, I think, is the ticker on this one. And I drew from the November low to the all-time high. And then from that, we have our retracement levels. So 38.2% would be at 242.94. 50% would be at 219.13. 61.8% would be 195.33. Those are really the main, very important ones. 78.6 comes into play sometimes. And there's another one. There's others that go up. But just for now, the popular ones, 38.2, 50, 61.8. And a lot of charting software would do this automatically. I use Trading View because they are our partners here at Zacks.com. So if you are signed up to Zacks.com and you click on our interactive charts tab, it's going to be a Trading View chart, which is fantastic that we have that capability. And then now here I want to point out, obviously, a gap. In this case, this is Corning, which had a really nice big gap up on earnings, going from below 96 to over 100. And now that gap, the top of that gap becomes sort of initial support. And you can see that just a couple of days after that earnings report is that gap, the top of that gap ended up becoming support. And in the future, the bottom of that gap would become support if that gap got filled. And gaps get filled often in a stock chart. It doesn't happen right away, but over time, it's amazing how often those gaps get filled. So here's an example, sort of a long-term example of a gap getting filled. So you got the Starbucks gap up in fall 2024. Nice rally up. That first pullback into September tested the top of that gap, which was support. Then he came down again at the end of 2024. In this case, it gets through that gap support. And where does it go? The 200-day moving average as support. Big rally. You got some other gaps along the way, but I want to look at that main gap over there from, the fall of 2024. And the gap finally gets filled in April of 25. Pretty interesting how that happens. I used a nice and choppy chart so we could get that too. All right, step 3 is use a trigger for entry. So this is an emotionless technical indicator that tells you when is time to enter. So this way you don't have any ifs or wishy-washy or depending how you woke up that morning, what side of the bed are you going to be long, are you going to be no, we're going to take that out of the equation. It's all about that trigger. And the moment that price confirms momentum is returning is essentially what you want to have out of your trigger. And if there is no trigger, then there is no trade. So how do we do this? We use overbought and oversold indicators. The reason being is the market moves in cycles, and extremes often precede reversals or pauses. The market always kind of overdoes it. They oversell, panic, go to the downside, and then they get too exuberant and crazy and irrational on the upside. And when that happens, it leads to these overbought and oversold condition in markets, which create opportunities for investors. So these tools help manage timing, not prediction. And again, that's something that we talked about in the beginning. This isn't about pinpointing on a map where the car is going. It's about, did the guy just drop the hammer on the gas pedal and are we starting to take off, right? So what does overbought mean? That essentially just means that price has moved too far, too fast, that the momentum is stretched, just getting a little long in the tooth, that rally, and there's a risk of consolidation or that risk of a pullback really increases. And on the flip side, what does oversold mean? Well, that means that selling pressure has reached exhaustion. Fear is dominating price action, and the risk reward now improves for bounces. Now, there's some key overbought and oversold indicators out there. The first one, which is what we're going to talk about here and what we're going to apply, is the relative strength index. You also have the stochastic oscillator, the percent of stocks above the 200-day moving average. That, my friends, is a fantastic overbought, oversold indicator when you're looking at the market as a whole. Definitely something you should check out. It is available again on TradingView, the percent of stocks above the 200-day moving average. When that gets really nasty to the downside, I'm talking you go under 20, it really presents itself as a time you could be buying in the market. And on the flip side, that gets over 80, and you got to start to be a little bit careful. And then the last is just the moving average distance. So when you see a short-term and long-term moving average, and then they've just really gone crazy, drifted far apart, and then they're starting to come back together, that's a really good indicator as well that maybe you're overbought and it's going to reel in a little bit. So introducing the RSI. This is a momentum oscillator developed by J. Wellis Wilder. Measures speed and magnitude of price moves. Again, I keep going back to this car metaphor. How far down to the ground is that accelerator, and which way are we facing? So how's the RSI calculated? It's a formula scaled from 0 to 100. It is momentum based, not price based. RSIs over 70 are an overbought condition. RSIs below 30 are an oversold condition. These are guidelines, not hard rules. So here, RSIs in strong trends tend to stay above 40 uh, when you're in an uptrend, and in a downtrend, they often cap it at near 60. So here's Micron. They've had an incredible run as of late, and you can see that 40 level on the RSI has been holding pretty well, even as you get these shallow sort of pullbacks. So you get the pullback in November to the 50-day moving average. You get another pullback in December to that 50-day moving average, and that RSI stays there. And now look what we have. We have an overbought RSI on Micron, but that trend is just so strong. So how do we use RSI as a trigger? Well, RSI refines our entries. Never trade on RSI alone. Always pair it with trend and trace for a complete system. Why not just trade on it alone? Because you're going to get a lot of whipsaws, and you're going to get counter trend moves, and you're going to get those retracements, or reversals that are retracements into support. So you're moving on the wrong end, right? You're counter trending sometimes, and you can get whipped in and out. Let's try to put the odds in our favor, get everything on one side, and then go with the flow. So here's an example of when this worked very recently. So if you look at Apple, eyeball this heading into, mid-January, you have a stock that is trading above that long-term moving average of the 200-day. It's below the short-term moving average. But of course, that's what you're going to want to see on a pullback to support. You're going to want to see the stock actually come under that shorter-term moving average and find some support with the long-term trend still intact. So in this case, I drew the move from the April lows to the highs, and our 38.2% retracement was spot on as the RSI got oversold. And you see that once, twice, three times it bounces at that 38.2. RSI trigger says go long and strong. Textbook example of a perfect trend trace and trigger trade. Now I have another way to apply this, and this is with a range-bound trend. So 200-day moving average, that slope is 0. That tells you we are in a long-term range-bound trade here. You have gap support on the trace. So that gap up on the November earnings, at the very bottom of that gap, is right around where the price is. Plus, you're right near the 61.8 of the move from the pre-earnings lows to the highs. And now you have the RSI coming down under 30, or 20 rather. So that, or under 30, yeah. So that ticks back up, and you're going to have a short-term buy signal here, which is great. But that's a range-bound buy, which means you're not going to hold it forever, right? You're going to look for a move back to those recent highs, and then you'd be thinking of getting out. Here's an example of a stock that's been beat up a little bit, United Healthcare. So long-term and short-term are both in a downtrend. Different from what we've seen before, because we have long-term, not only is it above the current price, but it's also negatively sloped. So that's a twofer that you don't want to see. Short-term also rolling over, getting real negative. It did come down to that gap support, though. We're in the gap up from that August gap. But even though it's oversold with that RSI, this is no trade because of the trend. The trend is so weak. You don't want to just get in here and try to pick a bottom. It's a much higher percentage entry if you wait for the trend to start to develop before you get back in. So patience is going to pay here. Speaking of patience paying, here's another. This is a member of the NASDAQ 100, Insmed Incorporated, and long-term uptrend. So that's a plus. You see that 200-day moving average positively sloped. We're looking good. Short-term downtrend. We're below that 50-day, and that 50-day is negatively sloped. We can see that. RSI nearing oversold, so it's kind of been bouncing down along there. In terms of trace, also 38.2 is kind of right where it's at, but that 200-day is starting to come up. I'd be way more comfortable sitting on this thing a little bit, seeing if there's more downside action. And even if it reverses up from here and I missed a trade, that's fine. At least I was patient. So this thing gets down to 138 and that RSI ticks up, then that's a much better entry. So you have all the patience in the world. There's a bazillion stocks out there. You can take your time and wait for the perfect setup. You don't have to try to force it. So why is this great, right? Common mistakes get avoided when you apply the trend, trace, and trigger method. You're not going to trace breakouts, right? Because there's not going to be any move back to that support along with that trigger. So you're not gonna enter a breakout on this. So you won't worry about those false breakouts that whip you up higher and then smack you down. You're not going to fight the trend. Yeah, sure. If you were to pick the perfect bottom, you might have the best reward there, but your risk is also bigger. Don't try to catch a falling knife. Big reward when you fight these trends, but the risks are much bigger because your win probability is so low when you're fighting the trend. Okay. Again, the trend is your friend until it ends. And this also helps you avoid over trading the chop in the market. You're not going to get chopped around all the time because the conditions of it coming down to support with that RSI being oversold and then pushing up through to give you that trigger is not going to develop. So you're going to miss a lot of that. You're not going to take a lot of trades, but you're not going to make a ton of mistakes either. And the final takeaway is it is simple, repeatable, and effective, and just let price do the talking. You don't have to predict the future. All you have to do is see what has already happened, and you can learn a lot from the past. I want to thank you guys so much for taking the time out with me today. Again, it's Dave Bartosiak here with Zacks.com. Have a wonderful week.